Wall Street's biggest bear is at it again, this time calling for a 10% correction by the third quarter. But could it be this upcoming earnings season that actually is the catalyst for a fall such as this? And is it even statistically likely? Today we take a look at why the puts have dried up in the markets and how fear has disappeared as they melt up higher. Which levels do we need to be looking at? Today we cover them all together, including stocks, commodities, and cryptos, and some very exciting opportunities that we discussed in our previous videos. And boy, oh boy, are they going absolutely bonkers. Join us, guys. Let's get into it. This will be a great episode. Well, welcome back everyone to The Daily Show. My name's Tom, and in today's video, we're discussing everything from the macro to the data to the key levels that we need to be watching as traders and investors. As we suspected in the last video, AMD and Intel were absolute blowaway hits after those huge weekly candles, and they started very strong in the options market. And we'll talk about those, of course, later on, along with some more opportunities. But if it's your first time here, remember to subscribe and smash that bell icon. It's great to have you on board. So let's begin with the story of Mike Wilson. Of course, well known as pretty much being one of the biggest bears in Wall Street. He's been calling some pretty big crashes since, of course, 2021. And in 2022, he was one of the most correct in the markets, of course, giving up on his bear campaign earlier this year. But he's at it again, and he's claiming that a 10% stock market correction could be happening before the US election. And then, of course, uncertainty may lead into that point. Again, citing the idea that the markets might be choppy and that Goldman Sachs and other kind of outlets out there are starting to point towards an overly extended market. So let's have a look at the evidence and break it down together of whether this is even possible and what we need to be looking at. Well, it's time for that chart again. Yes, the total put-call ratio is coming back. And according to bar chart over here, you can see that we're at a 0.58 ratio. Now, this is pretty low, and we actually haven't seen a ratio this low on this particular put-call ratio since 2015. Now, what happened after 2015? Well, we were in a chopping market that went down, up, and all around. So kind of 0.1, I guess, to Mike Wilson in some ways. Effectively, fear is gone from the market, and most people are buying calls and not buying puts. Now, if we look at the overall seasonality of election years, you might be aware, if you've been watching the channel, that we generally expect the VIX to start to pump up in July, usually the second half of July, into August, September, and October, crescendoing just before the election, usually at around that October-November period. And why is this important? Well, of course, this is one of the most well-known periods of time to see what we call seasonal weakness in the markets. Now, does that mean go and buy the VIX? Absolutely not. That's not what we do. But we do want to be looking at evidence of changes in trend, which we'll look at later on the S&P 500, and what you would be actually watching for to show weakness, which we currently don't have. But we do have other underpinning factors, such as single stock option volume actually dropping off here. And according to Goldman Sachs, the decline in single stock options volumes indicates reduced optimism about short-term stock gains. And historically, this low options volume / high equity level suggests a near-term weakness, and similar patterns have been found in 2023 and 2024. Basically, when we saw these kind of drops in options volumes, we often coincided with pullbacks in the market. So could this be a tell sign? I think it could be, and it's certainly, again, a bit of evidence to be putting on top of your technical analysis on charts. Now, what's been driving these markets higher? Well, in many ways, it's actually been optimism into this earnings season. And of course, the retail trader, you and I and everybody else. What have we been doing recently? We've been buying a ton of calls and not necessarily that many puts. Now, you'll notice before we had a chart that just said that call volume is down. Across the board, it certainly is. But still, there are certain stocks that are getting a lot of attention. And they're the ones that are really showing that strength. NVDA, Tesla recently, and even over the last kind of 48 hours, we've seen Intel, AMD, and many other picks that retail traders like to trade. Now, what this is leading into is a huge positive gamma shift that we've been having on the markets across the board, which has been driving up, in particular, the index, and we've been covering that now for months and months and months. And if that suddenly goes away and we turn into a negative gamma environment, you, me, everybody else will all need to be on top of this, because if we're not, guess what? Just like that, we could be looking at anywhere between a 5 and 10% correction, which could be an excellent buying the dip opportunity. And we'll talk about why it's most likely going to be a buying the dip opportunity later on today's video. So has it been a while since we've seen a decline of any kind? Absolutely. Since we've seen a last 1% decline day on the S&P 500, it's been 45 days. And that means that generally speaking, somewhere in this kind of highlighted zone, you would expect most of those outlier points to be cleared. Somewhere between 45 and kind of 60 to 70 days, usually you expect some volatility to come through. And that times in very well with the kickoff of earnings season, the big tech in around 3 weeks' time starting to come out, and obviously that then leading into the possibility of volatility coming into the market. We've also not seen 2% down day since the Silicon Valley Bank crisis. And this, of course, is the underpinning of the Federal Reserve, and everything is all good. And don't worry, if there's any problems in insolvencies, we've got your back. We're going to go and absolutely support each and every one of those regional banks. And of course, that's really underpinning in many ways the sentiment around KRE, regional banking in America. So could we be going down? Well, usually speaking, it's not usually July or August that brings the pain. It's generally September and October. And at least that's the stats when you go back from 1950 all the way to 2023, and you're paying attention to, of course, election years. Now, as we've already shown before, the VIX does tend to spike early. And of course, with this consideration of how random the politics are this year, we could be looking at an earlier point. So, of course, anytime the back end of July into August, September, October is open for some extreme volatility to come into markets. And ultimately, you'll be wanting to look at key levels. Another concern of people has been that we're seeing a lot of stocks falling and going lower while the markets have been driving higher. Why is that? Well, the top 10 stocks, the concentration of this market is very strong. And that basically means that we're in a bubble and we're entering into probably what we're going to be known in history as a super bubble. And is that a bad thing? Well, eventually, yes. But generally speaking, these last for a lot longer. And of course, the word bubble, I use it mostly just to kind of show that when people are using that word, usually you don't see an epic crash. It's when people say that there is no bubble in the markets after they did say a bubble before. That's complete complacency. That's when you want to be most terrified. And of course, this earnings season, just like every other one this year, has been expected to be quite good. In fact, the expectation of year-on-year returns from the S&P 500 is currently sitting, if you can believe it, at 17% per annum. That's an extreme number. And you know, if you know your historical stats, between 7 and 10% is kind of what you should be expecting in normal years. So if we keep getting these double-digit gains coming off 2022 lows, well, that's also something to be worried about, especially when you're looking at a longer-term time horizon. So where could the opportunities lie? Well, as we've discussed, we talked about metals getting a bit of love earlier last week, and that started to lead into, of course, gold, and in particular, gold miners. And gold miners are playing catch-up to gold, and you can see on this chart, they're still quite far behind. Depending on the inflation report this week, we might be seeing something pretty nice. And you'll notice here, according to the Prime Book, again, Goldman Sachs Prime Book for energy and basic materials shared for Menthol Q on X, basically, you've got some upticks here recently in a little bit of longing of both materials and the energy sector. And that's showing you that that decline that we saw all the way through 2023 and 24 might be upticking again. And if that's actually starting to uptick, then that could also be showing us that maybe inflation is back due to non-restrictive policies around the world. What's most important this week, always pay attention to the CPI number on Thursday, which will be where we find out about inflation, and of course the kickoff of some of these big companies. And you'd have to expect the airlines in particular to do very well, and you'd have to expect the banks to do really well. You know, to me, it's basically a time here where I would expect the banks to be lending lots of money at high rates, and I would also be expecting the airplane companies to be doing very well because we already know that attendance, especially over the July 4th holiday season, that period of time was bonkers. It was the highest we've ever seen in the US in terms of overall airplane flights and tracked numbers. Now, this is leading into some pretty big optimism during the most optimistic period of the year. And I'd highly suggest you also have a look at the first half of Jan and first half of Feb and put that into the back of your mind, maybe even save this chart so you remember the best 2 weeks period straight whenever you're looking at whether you've got bullish price action or not. Because of course, as of last week, as soon as we saw Tuesday or Monday close, we knew that market was going to start driving higher. Price action just said, bang, we've found the support, we're pushing off, and that can help you a lot TA plus data, one of our favorite things on the channel here to follow. Secular bull markets, we know that we are kind of in a period of time that is stacking up with 1949 to 1968 and of course the dot-com boom. Why? They're both concentrated markets. They both ran in very similar periods. And of course, they also ended up ending around the same periods of time. So what we are looking for here is, of course, a continuation of the strength in general, even with a 10% pullback, which is still, of course, possible. And generally, you do get 2 pullbacks each year. And so far, we are on 1 in 2024. But I think that it would probably be still a buy the dip. And the main reason is because we're not quite far enough along in the general process. Remember, these went 1,000 and 1,340, and we're probably looking at about 650, 680 at the moment in terms of the overall bull cycle. We also have to remember that stock markets work on optimism towards future earnings. And in general, we're seeing future earnings still with huge upticks. In fact, most of the market is still hyperactive until 2026 in February, where they're expecting incredible gains, in particular from the top 10 stocks, which have all got to do with AI. And AI is where the bubble is. And this is, of course, going to be that point where timing will be everything. So it'd be great to watch you or come along with us on the journey here on this channel, because I think timing will be everything over the next couple of years, especially when it comes to not getting involved too much at the end with the AI bubble. It looks so much like a dot-com bubble and every other piece of technology bubble of all time. And it's not to say the companies aren't great and earning money. They are great. You want to be riding those ones. But when it goes bad, let's just say it probably will go really, really bad. Let's have a look at rotational flow now. So semiconductors have had a little bit of a comeback over the last 5 days. We'll get into charts in just a moment. And then, of course, we've got gold out in front, loving GDX. I really think that's a under performance in the GDX. But, of course, that's been upticking over the last 4 to 5 months. And we also saw consumer discretionary come back, which we've been talking a little bit about, metals, etc., over the last 5 days. Now, this is all very important. And of course, you don't want to be seeing KRE, regional banks, go too badly. But when we look at the last 24 hours, it's pretty much the same story. Semiconductors came out. I would like to think that Intel and AMD playing catch up with some of the better gains there. They were certainly the best gains percentage-wise. We also saw a smattering of all sorts of different sectors that have been hit recently, including home builders. And we saw, I would say, like kind of a flat line across the board in most of the sectors. So nothing too concerning as markets pushed higher. Let's move over to the S&P, which closed, of course, at an all-time high. And we can see here that in general, when we look at the weeklies, we're looking at the deltas here. We went from having 2 incredibly negative candles over here to having a slightly positive delta. And at the moment, we're slightly positive. Now, I think it's important not to lose sight of these 2 massive negative candles. In many ways, this could be big players taking profits, and often markets will push higher before dropping off because they want to suck more people into the highs, effectively gaining liquidity in markets. Remember, the big guys don't care about the absolute tippity top. They just care about their overall position and whether they're correct on the general terms. So let's have a look at what could actually bring this market down from this perspective, because we do know that we're in what we call an extended market. Is the market melting up? Absolutely. Do you want to short a dull market like this? No way. I would not short it. And we've talked about that several times. We know where our key levels are, which we'll look at in a moment. And the market still has some pretty key zones. So, of course, 5,600, which is actually now where we move and to our Tuesday overall high to. We've got calls sitting at around 5,600. We've got positive gamma situation pushing us higher. And we know that from the structure of the markets right now, we have to suspect that pullbacks back down to 55.37 will still be met by bull demand for now. We know that pullbacks back to 54.75 might have buyers. And we know that the huge level where the bears really would take control of this market is still at 54.40, 54.50. Now, if it gets underneath that zone, look out. How many percentage points is that from where we are right now, though? So, of course, if we mark this out, you'll notice it's 2.5%. If we are going into a deeper 10% correction, you must break this level. And this level will really be kind of the catalyst towards somewhere between an 8 to 10% correction, you would have to think. And that's why that is probably the most important level for you to have marked out in your charts. But for now, what are we looking at? Well, in general, we're basically looking at a market that continues to push higher. And as you can see by the structure, it keeps making a series of higher highs and higher lows. And as long as that is backed up by this, which is the options market, you really don't want to be going against it. In general, we're in what we call positive gamma, and we know that each day, these 0 DTEs, as the market pushes through these key zones, today's one is going to be 55, 75. As it pushes towards those, it gets gravitated and is like a magnet towards these big levels. So today's big level is, of course, 5600, 5610, and this is where we suspect that the market is going to try to push to. Now, if it manages to get through 5610, as we know, based on the next session, there are so many options around there, it has that flow on effect. And you're really looking for this to change, this structure of the market to change. We almost got a change a week and a half ago now, but we didn't quite see that catalyst of price action come with it. So unless the catalyst of price action comes with it, while it's great to see the put call, while it's interesting to see what Mike Wilson has to say about the market and how he believes a 10% correction is coming, you don't have the evidence to go with that just yet. And that's a really important thing as traders, investors, and everything else. We must be looking for that evidence. Let's now have a look at some of the other reads. We've got, of course, the CTAs here. So Commodity Trade Advisors pushing up on the S&P, pushing up a little bit on the NASDAQ, but still lackluster to where they were. And where CTAs are really buying, the momentum funds are really buying, is metals. And we've detailed this for now over a week, and we've basically been talking about these copper traders, these gold traders going bonkers on the positions. They're really buying in on these particular positions, and that's leading to some nice early price action in what looks like potential positioning ahead of this week's inflation numbers. Will they be correct? Well, you never know, but certainly the price action has got some nice entries in it along the way. Meanwhile, Brent has actually continued to drop off as we stabilize at this 82 to 84 a barrel, which we'll talk about soon. And in terms of the most popular stocks out there, we continue to see a 130, 132 high for NVDA, as we know that unless we break through those zones, we're not really going into a super positive gamma situation. And we continue to see the same kind of thing also on our Tesla position. Now, this week's very important for Tesla because we've talked about it a little bit. We believe between the 250, 257 mark, we should be seeing sellers. So basically, while we were incredibly bullish on Tesla to 250 mark, which we certainly are, I do think that this could be a catalyst where it starts to find a little bit of problems. And of course, we're looking for the price action here. At the moment, we're making a prediction based on huge amounts of calls and hype, which you can see here through all of the strikes, that maybe it's time for it to take a breather. Tesla's well known to go on an epic boom and then to do nothing for quite some time and effectively coil in the market. And the options market could be suggesting that if we see this week especially close and fall below 245. So 245, 250 will be worth watching. Another stock that we bought up just over the weekend and obviously talked about was one that I've looked at a little bit with our Market Masters Club, which has been Intel. Now, I've been actually waiting for this like a praying mantis for a while, and it just showed an absolute beautiful price action dynamic, beautiful structure dynamic, and of course, options flow just went ballistic on Friday last week. And that led into a very replicable absolute explosion in these stocks. And of course, Intel and AMD were the two benefactors of that. Lagged semiconductors that were doing very poorly for quite some time. Now you'll notice we're in a super positive gamma environment at the moment. Basically, all these strikes, 32, 33, 34, they're all currently being priced above. So the market is absolutely booming. And the more and more and more calls that get in here, the more dealers will be offside and forced to push it to those next levels. We'll take a look at Intel soon, but this was a case of a very nice option structural change that happened in markets. So let's now jump into the charts. We'll look at the leads to start off with here. Central bank indicator, of course, showing that there's been a little bit of uptick as we get into these lofty overbought heights. We usually expect whenever we see these kind of signs, remember that the next 2 weeks can certainly be bullish. And then sometimes, well, that's usually where we start to see that structural weakness. So again, we're paying a lot of attention to the fact that options, as in here, put call ratios, no matter which metric we're looking at, they're really low. Basically, there's almost no puts there. They're all calls. And of course, we need to be paying a lot of attention now to these markets, specifically for smaller time frame price action. Put call ratio, contrarian indicator, Cannot use it by itself, but when it comes with other things, it does make some sense. Let's move over to home builders and home construction. It fell down. Some people calling this a head and shoulders. Obviously, I'm using this more from a macro environment, but it'd be interesting to see if it can gap up and find strength again. And for now, we're certainly paying attention to home builders because that's been quite weak. US dollar, not much going on here until we see the inflation figures later on this week in the banks. We know that we found resistance where we expected to kind of have problems. It pulled back, and now I'm looking for a little bit more catalyst on the weekly to get some idea. What about copper? Well, it fell exactly where we'd expect it to, around 465 to 470, and we expect it to pull back. I would be looking at like a 455, maybe a bounce off that, or the daily 20 moving average here. We love the daily 20 on this stock. We've talked about it many times before. For now, though, it looks like copper is finding those buyers. Gold is something similar. First bull level, just found some nice buying pressure coming off it. And second bull level sitting around 2328. And that's something that we will also be watching just in case it falls through. But for now, finding some nice structure, finding some nice buyers. And I think also if it gets above this high, it's probably going to make a new high for gold. So it's kind of going to do something like that and move higher. So gold certainly finding the buyers off the current drop. Thanks to, I guess, a bit of buying demand. GDX, not a bad session for it. Fell off in the morning, came back strong. Great weekly close here. And it suggests that GDX, that is gold stocks, might be playing catch up. First take profit target on this would be about 40 for a trader. So hopefully it can do that. And then it comes over to oil. We had an amazing run on oil. We got to that 84 a barrel that we expected to find resistance at. And now we're pulling back down. Now, I've put here a level of around 81.50 a barrel. I think day traders, scalpers, everyone like that will be watching this zone very closely. Decent amount of catalysts on that one in terms of confluence targets, and anywhere between 81.50 and 80.50 a barrel should be where we rest leading into the CPI. I would expect to be somewhere here leading into the CPI, and hopefully the CPI will give us a catalyst. Whether that's going to be a bullish one or not, I don't know. But we do know that this is where we expect buyers to recommit. So it's not quite there yet. Let's move over to Tesla now. So we can see here, even on exhaustion indicators alone, Tesla is exhausted. It's had a great move. It's coming up to a key resistance. And it has a lot of the metrics that I would usually pay attention to. You can see that these are relatively good reads. Of course, sometimes it's not when it's coming off a super base. But I would say that looks like a pretty extended market. And of course, whenever you get these types of reads in extreme extended markets, you must be paying attention to it. 250, little bit of a sell-off coming off the 259. And it's kind of breaking down here a little bit, but it hasn't exactly shown signs of weakness. Have we got a lower low? No. Do we still have a higher high series? Absolutely. Can this stock blitz it? Of course it can. 280 is still a target if you were looking, and 300 is still targets. And this is a point where I was talking about the other day of traders might be wanting to scale. So scaling could be something that's considered. And do remember, if we do have a sneaky market that decides to actually fall off, it could be these types of stocks that actually get hit. Ones that have rallied a lot based on really hype train. And of course, yes, news, but really we know it's options and flows. And we need to be careful. So 250, still looking for what I would like, which is this. That's what I'd like to see. A pullback in time with a slight correction. That would be fantastic for Tesla traders. Let's move over now to another pretty decent one, which is AMD. Of course, we saw a lot of similarities with this and Tesla. And it's been exceptionally good in terms of the great run the last 24 hours and the last 48 hours really in terms of trade. And in general, this has been quite bullish. We're still looking for at least a minimum of 182.50 on a stock like this. And it looks like it's going to try to get there, maybe even over the next couple of sessions. Another big winner was Intel, a hated stock. Most people didn't want to talk about this. A very interesting floor that was created with very good volume. Of course, Wyckoff's Law number 3, one of our favorites when it comes to recognizing price action at the lows, and a nice movement up. Now, where do I think this thing could be going? Well, it's already hit almost the weekly 20 moving average, which is 34.50-ish zone. But of course, mean reversion is there, but it could even be looking at a 61.8 retracement. Now, if you put a 61.8 retracement in from the last low, you'll notice that pushes pretty high to $40. Is it possible for Intel to get that high? It really depends how much hype goes through the internet as more and more people start to see it. And guess what? I just saw it start to appear in articles today. So, of course, you've got to be early, guys. You've got to be a pig. And that's why I bought it to you earlier than any of these articles talking about it. And that's why you get those exceptional returns. 6% plus, does it happen quickly? It does in this market. The AIs are fast. And of course, the spread of information, the spread of that party happens pretty quickly. So Intel looks like it's probably around 2/3 of the way through the basic move. Somewhere around that 34.50 to 36 would be where I'd expect it to have a bit of trouble. And if it blitzes that, $40 is the next target. All right, let's move over to some other things. Semiconductors versus SPY. Not a bad little comeback here thanks to some of the lesser semiconductors. Obviously, what we want to do here is take a fib from the high to the low, and we want to look at that, and we see golden pocket Fibonacci level. This would be where you'd start to expect a bit of weakness in semis if they're going to come back in. And what I'm really looking for in semis is not that I'm horrified at the sector. I think the sector's going to make all-time highs and go ballistic still. But I do expect it to have a little bit of a breather, what we call a pullback in time or a slight correction. And in general, I'm looking on this combo to get it back to mean reversion, which is the weekly 20 moving average. So that means that this plus NVIDIA hopefully just kind of stay down for now. It would be healthier for the stock to do this. A lot of people disagree, but it would be healthier if it can do this. 130, 132 remain the soft kind of resistance points, and you can see 132 sits on the 61.8 fib, so that will be important. And then we move over to the China market. 700, 10 cent, still really good, still looks all right. Meanwhile, though, the rest of the China market making a new low. So it's really still around that 61.8 fib retracement. We're looking for swing trading levels in the future. We don't have any of those yet. It's very important as a catalyst trader. Remember, we saw a great scalp or day trade in here last week. As a catalyst trader, as a momentum trader, as somebody that wants to really get in and then see hopefully gain on gain on gain over the next couple of sessions, that you wait for the trigger points. And at this point, are you at a position or buy the dip area? Certainly a key point I've been watching for a long time, but it hasn't found a buyer yet, has it? So continues to weaken. And just remember, when we started talking about China, we were over here. So China's still up a lot. It's just not up as much as it was at the peak. And we expected some problems just before 20K. That's to be expected. So definitely, I've been seeing a lot of information about the government trying to plug all of these holes. And that's because they'll do anything to basically support the economy. They do have some pretty deep coffers, so I expect them to continue doing that. Qs, still very strong, guys. Obviously extended. We all know that. However, extensions can go longer than you expect. So remain bullish for now. Series of higher highs and higher lows. If that changes, I'm thinking the S&P 500 will tell us. Now, a few of you have probably got questions about the Russell, as the Russell had an okay 24 hours. Nothing really changes here. Unless this thing's above 2100, it's in Chop City, and I don't think the Russell's that interesting. Now let's move over to crypto world. So Ethereum takes the low, watch reaction, has a big reaction, comes up, looks like a double bottom at this point. You can see here the low and the almost equal low. And this area is actually where the main interest is. So this little structure here, that's actually where the big shorts are. And you'll notice that we react off that already twice. It's come back up, which is a good sign for the bulls. If it blitzes this, that's a great sign for Ethereum-based traders. On Bitcoin, I would have liked to have seen a new low and, of course, hit 51.8. We don't know, that's not going to happen yet. The first bull turn zone is 59K, and I think the huge swing zone is around 64,000. If you are like a really big bull, you really want 64,000 to be closed above. That's great. That brings in swing traders, and I think begins a new all-time high with the evidence that we have at hand. Now, do I really care about MT, GOX, German market, all this other stuff? I think it's pretty fuddy. I wouldn't pay too much attention to it, guys. If I was you. In general, you want to be looking at price action. Ignore the narratives. Look at the price action at the moment. We know the market has come down. It's gotten very close to beautiful level. It's found a buyer. It hasn't said, I'm ready to go long just yet. But yeah, we'll have to, of course, assess it by the video. If you enjoyed today's video, please remember subscribe, guys. In terms of information coming up, we know we've got Fed Chair Powell having a chat. We've also got him on Wednesday annoying us again. And then on Thursday, he's prepping us for that CPI number. On Thursday, we've got the CPI. I'd be interested to know what your comments are down below. Is CPI coming in hot or cool? Let me know, guys. And as we know, the big one is really going to be Friday. And that's because we've got PPI and the banks reporting. I would expect the banks to have some nice numbers. I'm sure they will beat expectations across the board, whatever those expectations are. But yeah, it doesn't mean it's going to enter into a great trade for it. Yeah, I'm not really sure that will be there. As always, guys, thanks so much for watching. Check us out on X as well if you're interested. We do post charts over there and information. And we'll see you in the next one. Bye for now.